Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Tom Tzitzouris. Tom is a managing director and head of fixed income research at the firm. Tom, how are you doing this morning?
I'm doing great. Thank you for having me on.
Thrilled to talk with you. A lot of things happening in the rates market, reflective of the economy and inflation. So I wanted to start big picture. I think, the first quarter, first part of the year has been quite strong, but along with that has come a tick up in expectations for the terminal Fed funds rate, so where it peaks, and then how long it will stay high. So could you maybe break down what you're seeing and what that might mean for the economy and odds of recession in the next 18 months or so?
Yeah, well, let's start off by saying, first off, Fed Chair Powell 2 weeks ago indicated to us, that is the public, that the Fed was nowhere near done tightening, had more rate hikes to come, and was likely to hold the Fed funds rate at whatever terminal rate that was for the entirety of this year. So, for example, the market before that was saying, well, the Fed's going to terminate the funds rate at 475, and then we're going to have cuts by, we'll say, September, October. After that Fed meeting, Powell indicated again that the Fed sees itself terminating the funds rate more like a 5.25 to 5.5 and holding it there for the entirety of the year. But the market didn't want to believe the Fed, at least at first. Then you had a hot jobs report. And since then, you've also had a hot CPI report and a hot PPI report. By hot, we mean inflation and wages coming in stronger than expected, and job gains coming in stronger than expected as well. That has reinforced the language that Powell shared with us 2 weeks ago. And now the market is saying, yeah, we got a lot of work to do. And you've seen interest rates pop higher across the entire curve ever since Powell's statements in those hot reports. And with that said, I want to indicate we had another strong inflation report this morning. Today, it was the PPI, came in stronger than expected. And what it's telling us is that the economy is relatively strong right now. It is not in recession, but inflation is beginning to re-accelerate again in some corners, some pockets of the economy. And that's a very concerning sign. That also tells us that the Fed, in its tightening phase, may have much more to go than the market is pricing in. 5.25 may be not enough at this point.
Right. So it's really the market coming around to what the Fed has been saying for some time, at least longer than the market had priced it in. One of the big kind of confounding things this cycle has been, and especially lately as the market has rallied and the economy has showed some signs of strength, is that the yield curve, the spread between short-term rates and long-term rates, has remained deeply inverted, which is often a recession predictor. It's a very famous and good recession predictor. What do you make of that? Is it wrong this time, or is it right just with maybe a lag that people aren't expecting?
Yeah, I'd often tell people the yield curve is never wrong. The bond market is the world's best forecaster of recessions and inflation. It's not perfect, but when it comes to yield curve inversions, the signal is never wrong. Yield curves, without going into too much detail, yield curves, if there's no credit risk embedded in the curve, it's almost mathematically impossible to invert the curve unless the central bank has committed a policy mistake. And what the bond market is saying is the central bank is in the process of committing a policy mistake by tightening too much for the Main Street USA. Now, with that said, we don't know when that policy mistake translates into a recession. So there is a variable lag between the inversion of the curve and the recession. But the predictive skills of this indicator are always, as far as we're concerned, 100% spot on. And so what it's telling us right now is the Fed, whether it terminates the Fed funds rate at 5%, 5.25%, 5.5%, it's going to eventually do enough damage to aggregate demand to bring the U.S. economy into a recession. We may not be there today, and we may not be there next month, but before the end of this year, we're very likely to be in recession. And that's what the yield curve is telling us. It's telling us that the Fed is going to have to eventually stop its rate hikes and begin rate cuts. More specifically, with most of the curve somewhere between, we'll say, 3.50 and 4%, at least beyond 2 years, the market is saying eventually when the Fed does begin to cut, it's going to cut rates down to about a 3.50 or a Fed funds rate somewhere around a 3.50 to 3.25 to 3.50. So it's also telling us where the market sees those rate cuts terminating themselves on the bottom when the Fed does begin its rate cut cycle.
So, with that outlook and with the kind of complex economic environment that we find ourselves in today, Where are you finding value in the fixed income world? Is it, taking credit risk, something like high yield or investment grade? Is it on the duration spectrum, going longer term maturity versus shorter term? Where are you finding value and how are you positioned today?
Yeah, specifically, we find value in the shorter end of the U.S. investment grade corporate curve. We'll say somewhere between a 1 to 3 year maturity. And in the Treasury market, we're finding value around the 1 to 1.5 year portion of the Treasury curve. But in both cases, the value right now, no surprise because we have a deeply inverted curve, the value is in, we'll say, the 1 to 3 year portion of those curves. With that said, we do not right now, because we're so late in this business cycle, in our opinion, and very likely to see credit risk rising as the Fed continues to tighten, we don't see an awful lot of value in the high yield space or even in longer duration corporates right now, because simply put, credit spreads are likely to widen out this year. And whether you're looking at a high yield spread widening from 400 basis points to 600 basis points, or even a long duration corporate spread widening from 120 to 150 basis points, you're looking at underperformance in those types of assets. So we're seeing a lot of value in short duration or intermediate duration investment grade corporates and treasuries, not a lot of value in extended speculative grade credit, and that goes for bank loans as well. We're moving up in credit quality, we're moving up in defensiveness as this business cycle and credit cycle matures.
Tom, that's really, really tremendous insight. I think a lot of actionable takeaways for our advisors and clients. So I want to thank you so much for the time and hopefully get to talk to you again soon.
My pleasure. Thank you.